gold's going to 10,000 and silver's going to 300, sentiment just went off the charts bullish. So I sold. I told clients who wished technically there was nothing wrong with this correction. Gold went up 100 and something percent just last year, and in 2-3 years it was up almost 250%. It was entitled and in need of a corrective phase. Number one important factor when it comes to gold, central banks. You know, there were a lot of years when I was in gold when they were big sellers. And between the manipulation of the paper traders and central banks being sellers, it was difficult for gold to go up and sustain any moves. 2 days ago, Gold Miners Bullish Index hit zero. If I'm right about the stock market peaking, they'll be played with the stock market and come off. But if they came off another 20% again, I think I would look at them again. We saw several of the governors move away from the cutting rates and start talking about raising rates. One of the things that was interesting about the bond market, short rates went up sharply. When we went to talk, the 2-year was up 10 basis points.
You mentioned, you went long precious metals, I think it was a couple of weeks ago. What was, I guess, the influence for you to do that? Why did you think it was the right time to get in? And you still think it's looking good in the near and long term?
Sure. So this will always cause some, I hate to use the word gold bug, so I don't think people should be called that, but people who live and breathe it and never go out of it don't like hearing this when I say this, but for years and years, I've stated it. I buy gold and silver because I think it's going to go up, or and I sell it because it goes down, not because of an end of the world, or even I'll be able to use it as money when other money won't count and all that kind of stuff and all. That's my primary reason to own them, has always been and will be capital appreciation versus anything else. So for a lot of years, from 1200 all the way up to this past January into February, I was a gold bulk. I did move from physical metal to mining shares and then juniors. But when gold went completely parabolic and silver even more so, I said, we've gone too far too fast. Every 2 minutes in the internet, somebody's launching a rocket or I'm getting an email of why gold's going to 10,000 and silver's going to 300. Sentiment has always been the key part of how I make a decision on to buy or sell anything. Sentiment just went off the charts bullish. So I sold, and I told clients who wish they wanted, if they listened, if they wanted to.
Markets usually become most dangerous right when everyone starts calling caution outdated. Peter Grandich notes that his trigger wasn't inflation panic or collapse narratives. It was sentiment reaching levels that historically punish late buyers. Gold moving from roughly 1200 into a parabolic phase created the kind of emotional excess institutions often distribute into quietly. Retail investors chase price targets. Disciplined capital watches positioning. Next, Peter Grandich reveals why a violent sentiment reset may actually strengthen the longer-term metals case.
We got down to a point a couple of weeks ago where the sentiment basically almost made a 180 in a very short period of time. And understand this, technically there was nothing wrong with this correction. You know, gold went up 100 and something percent just last year, and in a couple, 2-3 years, it was up almost 250%. It was entitled and in need of a corrective phase. In fact, if you want to believe those high numbers, which I still think are possible, it is better that it's done this than if it would have kept going straight. It even made it to there because it would never stay there. So the sentiment changed. The other key factor, and this I think is the number one important factor when it comes to gold, central banks. You know, there were a lot of years when I was in gold when they were big sellers. And between the manipulation of the paper traders and central banks being sellers, it was difficult for gold to go up and sustain any moves. Well, most of that manipulation, how it used to be, is gone because physical markets have moved to Asia and they're more interested in the physical end of the business, not the paper. But central banks, which was the key reason why I was so bullish a couple of years ago about BRICS and how we're going to eventually use gold and to rescue this, however it ends up being rescued from this horrible fiat crisis we have, not just here, but in other countries, central banks remain buyers. Yes, one or two during this war had to sell, and thank God that they were smart enough to buy the gold in the first place, so they had something to sell. But this was still an extremely healthy corrective phase, and the sentiment. Listen, Anthony, there are people I used to speak to that on the speaking circuit for 25 years that are still around.
Central banks keep talking stability while continuing to accumulate the asset that competes with confidence in policy itself. According to Peter Grandich, the correction mattered less than who kept buying underneath it, and that signal remains institutional, not emotional. A near 250% move without consolidation rarely ends well, but official sector demand changes the structure beneath price. Savers focused only on headlines miss where reserve behavior is pointing. Next, Peter Grandich exposes the one institutional shift that makes paper narratives increasingly harder to sustain.
I didn't listen to them. I don't listen to now. But there still are a few and some new people I found. Even some of the sharpest people suddenly turned bearish. And when I knew I believed I could eat these words in a few weeks, but when I knew I hit the right turn 2 days ago, the Gold Miners Bullish Index hit 0. I don't ever remember, and remember it can only go to 0, so maybe it did tie it one time before. But when the gold mining can't find any bullish indication, so we're at 0 on the index, the sentiment is telling us we're much closer to the end of the decline than the beginning of the decline. So those things made me at least get back in, and now I have some parameters to get fully invested if gold does something on the upside or something on the downside. But I will tell you this, I would sooner have a gold-related portfolio starting today, whatever the 5 top gold stocks would be, than the 5 top semiconductor stocks, the 5 top AI stocks, even SpaceX. I feel much better because the fundamentals, especially when we get to base metals and critical minerals, is more bullish now than it was 6 months ago when people were talking about it and excited about it. We need it more now than ever. So those type of companies who are still quite happy to make profits at 4,500 on gold when it's costing them 2,000 or less maybe, and copper approaching 7, these are the things that just demand being involved in the mining end as an investment portfolio.
Yeah, great. It makes a lot of sense. So you have these, set things that you're looking for a specific sentiment. Is there anything else that you think is maybe underappreciated at the moment and has low sentiments that you're watching?
When bullish sentiment hits 0, markets often become most dangerous for people waiting for perfect certainty. What Peter Grandich is highlighting is not blind optimism, but a historical setup where exhaustion replaces conviction. Extreme bearish positioning in miners while hard asset economics improve creates a disconnect institutions quietly study before reallocating. Investors protecting purchasing power should watch capital flows, not headlines about AI dominance. Next, Peter Grandich unravels why neglected commodity sectors may be entering their strongest phase.
It's hard. There's no real sectors. If I was a younger man and it's going to spend the next 10 to 15 years, one of the clear issues that we're going to have further about is water. I also think uranium, which I was once, call it a bug, whatever, the shares got caught up in the stock market move. The uranium argument is even better than the copper argument. We know things like wind, forget it, that's done. People have seen what's happened with all these windmills and all that kind of stuff. Even solar is much more limited than people thought it was, and so forth and so on. The only way the next generation is going to be able to have all the electricity they want and not have a problem with brownouts and all this, you're going to have to build nuclear plants or smaller nuclear reactors or something, without question. China's realized that, and they're going to be in a much better shape to provide electricity than the 4 different grid systems we have in the US that are so antiquated that I like to joke Thomas Edison built part of it. So that need and nuclear. The one negative about the uranium is you can count on both hands at best the number of publicly held companies that sell it, produce it, or are involved with the physical end of it. All the rest is exploration, hoping to find it, which some may. But by the time they hit it, find it, and bring it in, the uranium play could be over. So I would want the prices to be more in line than where they were before them, when they went to, they've come off a lot. But I also think if I'm right about the stock market peaking, they'll be played with the stock market and come off. But if they came off another 20% again, I think I would look at them again.
The next resource crisis may not start with scarcity. It may begin with electricity demand nobody planned for. Peter Grandich's argument suggests investors are looking at commodity charts while missing infrastructure timelines measured in decades. Energy transitions sound smooth in policy speeches, but become brutally physical in execution. Wealth preservation means owning assets tied to necessity, not popularity. Next, Peter Grandich reveals the hidden bottleneck that could redefine commodity pricing.
Okay, that makes a lot of sense. Thanks for outlining that. And another thing that seems to be a very busy news day. We're speaking on the 17th of June, and this is going to go up at a later date. But Kevin Walsh had his first sort of meeting. And yeah, he's come out a lot more hawkish, I guess, than a lot of people thought. People thought that he would potentially be a Trump puppet, and that definitely doesn't seem to be the case. So what did you take away from his first meeting?
You're right. And I was glad to see it in this sense. I know people hate the Fed and there's a lot of things. I thought he handles himself quite well. In fact, I always felt Powell was timid. I think Powell's wish was clearly not to be there. And the last year or so, what was happening with the president, just, I think, beat him to a pulp. Why he's actually staying on, I have a feeling he stayed on just to, in his sense, throw something back. I think if he feels that Walsh is not the puppet that he thought maybe he was going to be, he'll resign that position or wait till at least Trump is gone to do that. But I think we now see over almost 6 years of the Fed not meeting their so-called target. I think one of the things that we've seen out of this one press conference, he is not going to be overexcited to spend every waking moment talking about what the Fed is going to do. He clearly sees other Fed governors, but keep this in mind. We saw this in the March meeting already. We saw several of the governors move away from cutting rates and start talking about raising rates.
The biggest risk to portfolios may be assuming central banks still control expectations the way they once did. This is where Peter Grandich's thesis shifts from metals into credibility itself. Markets price narratives until policy language starts diverging from actions and voting patterns. Long-term investors should care less about rate headlines and more about whether inflation tolerance is quietly being rewritten. Next, Peter Grandich exposes the contradiction buried inside modern Fed messaging.
So this isn't just because of what happened in the Middle East. And the numbers we've seen in inflation are not just because of energy. They're more widespread. And I think the other surprise to people is we're not, there were, before the Middle East, there were people talking about oil going back to $20, $25, or $30. I don't think we'll ever have the same peace of mind on oil, especially from the Middle East, now that we've seen what transpired, and still feel now could actually happen again faster than even before. And one of the other changes that I talked about yesterday in a piece that I wrote about the Middle East, the Gulf nations have to be saying to themselves, this guy in the White House is not Bush. Because when Iraq went into Kuwait, the United States was there. All sorts of people joined them and all. And, I think they feel that let down, especially when he was just over there a year ago and they were talking about giving him trillions of dollars and all. So I think the opening for a country like China is going to be more open to deal with and less about the United States. So I don't think we're going to get as much of a decline in the oil price or gas prices even go back to where they were before the crisis. And therefore, the challenge for the Fed will be to probably, I think the answer will be is they'll get rid of the 2%. If we have another couple of months of even higher inflation for whatever reason, the 2% number is going to be told that it's just not realistic. But one of the things I think we saw, and again, since you and I talked, I don't know how the market finishing up. One of the things that was interesting about the bond market, as short rates went up sharply.
The market keeps pricing cheap energy, while geopolitics keeps repricing certainty. Peter Grandich notes that inflation pressure may no longer be cyclical if energy expectations and policy assumptions detach at the same time. Bond markets often react before public messaging changes, which is why short-end moves deserve more attention than headlines. Savers face the greatest damage when official targets quietly shift after capital is positioned. Next, Peter Grandich reveals what bond markets may already understand about inflation persistence.
When we went to talk, the 2-year was up 10 basis points, but the 30-year was actually down. And I think that's a sign to saying, hey, these group may be more interested in getting ahead of the inflation problem. One thing is clear, the last 2 Fed governors were viewed as behind the curve. Now, I think at least from what I saw today, and again, not knowing how he finished up or how the markets reacted as you and I speak, there's a sense, it seemed, that maybe this guy is going to get the group not to be behind anymore. Will they get far ahead? I don't know, but they're not going to be too far behind.
Yeah, okay, makes a lot of sense. So in terms of global economies and global markets, is there anything that any thoughts you have on them? You mentioned China, obviously, but any of the other economies?
So in our planning group, my suggestion to any of our potential clients or clients is I don't want to own any U.S. equities here that aren't related to metals and mining. But I'm not adverse of some countries and some areas in the world, Asia as a group and China and Singapore as an individual. There, I feel much more comfortable at where their economies are and the strengths that can come from it. Now, the key here also is the bond market in worldwide has been the canary in the coal mine. Let's not forget that most bond markets have been in a bear market for 3 or 4 years in most major markets, including our own. Japan, which for a lot of years was really a fuel for liquidity into all markets, including our equity market, because of the yen carry trade, now is seeing more strength, and they've just seen their first raise in interest rates.
Markets can rally for months, while the bond market quietly withdraws permission. According to Peter Grandich, the signal is less about rates themselves and more about where global liquidity stops flowing. When carry trades reverse and capital finds alternatives, yesterday's market leaders become unexpectedly fragile. Portfolio protection means watching funding conditions before price damage appears. Next, Peter Grandich exposes why global liquidity shifts rarely announce themselves first.
That could end that push or gas that our equity markets used to get. So that's something to watch. So if you see continuing rates going higher in Japan and stronger economic results, that's actually a net negative for some world markets, particularly ours, because I would say that our market benefited the most from the yen carry trade. And therefore, that liquidity may actually start to shift and want to get back over there compared to being here now.
Yeah, I have the personal opinion that a lot of these governments or states are quite inefficient. And even though, they probably people need more money, it could be allocated in better ways to actually get to the source better, rather than through, there's so much contracting and so many potential scams that we're seeing, or fraud. I wouldn't go as far as fraud. Yeah, probably. Okay, if you have fraud,
call it what it is. And you think about it, we saw so many. We had this young kid no one even knew of. He went out and found all these places, how much has happened to, what was the follow-up to that? And then here's the biggest problem, Anthony. So the people we would hope that we've elected to go fix these issues, we have from both sides of the aisle, forgetting the president and his family for a moment, which estimates now are in the billions, what has been made in the administration. We have numerous Congress people, men and women, Democrats and Republicans, making tens of millions, if not hundreds of millions, in the stock market, mostly from information that they've learned from their work and don't get charged in the same way we do.
Liquidity leaves long before confidence does, and that sequence catches most investors unprepared. What Peter Grandich is highlighting is that capital migration can expose weaknesses that politics alone cannot explain. Markets thrive on trust, but incentives and asset flows often tell a different story than public speeches. Investors focused only on index levels may miss structural changes underneath. Next, Peter Grandich unravels where policy narratives and capital behavior stop matching.
And a couple of weeks ago, the House Speaker says in a press conference, I'm paraphrasing, but this is basically what he said. They only make $175,000. They're trying to find a way to supplement their income. Oh man, I just tell you that's like the wolf watching the hen house. And that's where the real problem is. The real problem is in the political spectrum and the morals that are completely gone. And it's not just in the federal level. You wouldn't believe some of the issues we have in New Jersey and some other. I live in New Jersey and some other states, and it's getting worse, not better. And the watchdogs, like the Attorney General that was brought in, and all these things that were found that just suddenly just disappear and never heard about again, is because it's very corrupt. And the few that aren't recognize it's futile and they leave. They just don't go forward. And that's a big issue too that a lot of people don't like to speak about.
Yeah, and I guess that's a good thing the US has, that at least different states have different, regulators, and if you don't like one state, you can move to the other. Whereas like other countries, such as in Europe, basically the states or the counties or the regions don't have any control, so you can't really escape governance unless you leave the country.
But you know what's happening there, Anthony? Let's take, for example, California and New York, where taxation is getting so large. Billionaires are actually leaving, and they're going to Florida or Texas. Especially Florida doesn't have any state income tax. But a lot of those people leaving are not necessarily all from the party that currently controls those states. So while they're coming to the state, they still believe and bring their political beliefs.
People talk about elections, but capital often votes months before ballots do. Peter Grandich's argument suggests that investor behavior reveals confidence levels more honestly than political messaging. Tax migration, capital concentration, and perception shifts can reshape markets long before economic data confirms it. Wealth preservation means recognizing incentives instead of reacting to narratives. Next, Peter Grandich reveals the contradiction between political promises and money movement.
And that's why states like Texas now, that no one ever imagined could go Democrat or what have you, some of that's happening, including on the governor and Senate level and all. So the politics in the coming months is going to become much more influential in our markets than they've been in recent times.
Yeah, it'll be super interesting to see. So
politics becomes a market variable when capital starts moving faster than policy. This is where Peter Grandich's thesis shifts beyond elections and into investor psychology. Markets can absorb disagreement, but struggle when confidence in governance and capital allocation weakens simultaneously. Long-term investors should watch flows, taxation, and incentives more than campaign language.